Corporate finance practice problem using OneNote. Merger and earnings per share. Get ready. It's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 2015 Merger and Earnings per Share tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will be down in the text area as well. Same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculation down below. We're looking at a merger or acquisition type of situation, focusing in on the earnings per share calculations before and after. Note, as we look at these, we're going to look at some fairly or more simplified type of examples to get the concept of mergers and acquisitions here. If you want more detailed information on some of this kind of concepts, take a look at our advanced financial accounting course where we go into these mergers and acquisitions more in depth. For example, one of the concepts with regards to a merger is a situation where not the 100% of the shares are purchased, because obviously anything over 51% would in essence give you a controlling interest, and that's where things can, one way that things can get a little bit more tricky with regards to the mergers and acquisitions. So again, if you want more detail on that, take a look at the advanced financial accounting course. So we have all shares of A company are exchanged for shares of B company on a share for share basis. So in other words, we're imagining company A, company B. We're basically assuming that B here is in essence acquiring, consuming company A in this process. The total earnings for A and B are $610,000 for A, $670,000 for B. Shares outstanding for A, 196,000. 455,000 for B. Earnings per share for A, 3.1, for B, 1.5. Now, we're going to imagine then that A is going to be giving all the shares outstanding, the 196,000 shares, giving complete control to B, but B is going to be generating new shares and distributing new shares on a one-for-one type of basis. So they're going to be creating 196,000 shares, issuing them in compensation for the shares that they're going to be getting for A. So that means A basically will be owned by B at that point in time. They will be completely controlling, and that also means that B, in order to do so, will have the more shares outstanding. So this can get a little bit complex, because when you think about them together now, you would say, okay, well, the earnings have gone up, because now you have A and B have the total earnings together. But also, if B had to then create more shares, in this case 196,000 shares, in order to basically pay for the acquisition of A, that also means it's going to be more shares outstanding. So the question then is, what's going to be the bottom line impact on the earnings per share after this is all said and done for B here? So to calculate that, it would look something like this. We could say, okay, well, the earnings for A, 610,000, the earnings for B, 670,000. That means the total earnings would be going up to 1,280,000. But, and that's good, that would increase the earnings per share. But we can see that the starting shares for B are 455,000, and if they distribute another 196,000 shares, that means the shares outstanding would be at the 651,000 shares. So if we consider the earnings per share kind of basis, then we're going to take the 1,280,000 divided by the 651,000, and we've got the 1.96. So that's going to be the consideration we have. Notice again, things get much more complicated if you have a situation which, if there was a purchase for like 51 or over percent of the shares, because then you've got the controlling and minority interests in the acquisition process. And again, for those types of situations, take a look at the advanced financial accounting course where we'll go into that in a bit more detail. Let's look at another one here. We're going to just say all shares of A company are exchanged for shares of B company on a share for share basis. So now we're going to say that the total earnings for A, 3,034,000, for B, 7,900,000. The shares outstanding for A, 846,000, for B, 4,300,000. The earnings per share for A, 3.6, for B, 1.8. Same kind of thing. We're going to just say that B, or B is going to be basically acquiring, consuming A giving up all their shares, 846,000 to B, giving 100% interest in A from B, basically consuming A, B basically consuming A in that case. And in order to do so, B is going to be paying for that with shares that they will be distributing, and they're going to create more shares and issue the shares to do that. And if it's a one-for-one kind of situation, they're going to be creating 846 shares in order to make the exchange and pay for the acquisition process. So once again, the earnings would be going up. We would be combining the earnings together, which would increase the earnings per share calculation. But if paid for with, in this case, the stocks, then you would see a decrease in the earnings per share for the more shares that would be outstanding. So we combine them together, earnings for A, earnings for B. If they were to merge or be acquired, we'd have the 10,934,000, and then the shares outstanding started at the 4,300,000. Plus, we're going to assume B issued more 846,000 shares in order to exchange for A's shares for the acquisition. That was basically the cost. That means that we have a total now of the 4,000,003 plus the 846 of 5,146. So the earnings per share calculation, 10,934,000 divided by the 5,146,000 is going to then give us the 2.12 on the earnings per share after.